cities change over years and decades, really.
Yeah.
So you look at the metrics for a long period of time, and then you can kind of project where things are going to be in the future.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always, we got Matt Jones. Matt, how are you doing today?
I'm doing great. How are you doing, Todd?
I'm doing fantastic, man. Just put in an offer for almost a 600 unit deal. So kind of excited to hear back from that. It's a portfolio. So I put in actually 4 different offers. I put an offer for the entire portfolio, for a portion of the portfolio, and then for a property individually, for 2 different properties individually. So we'll see where it goes. I gave them plenty of options to choose from. I'm hoping to get the whole portfolio, but worst case is I get a couple of those properties I put individually. I guess worst case is I get nothing. But you know, that's not going to happen. I'm going to get something here. So you got that. That's exciting. Got a couple other LOIs in that we're working on. So just trying to push forward and move on. There's obviously concerns with what's going on with the market, but with good, strong cash flow, with ample reserves, with kind of all the fundamentals that we look for, good financing, good, well-located properties, I still think buying makes sense. So pushing on.
The deal flow is definitely better than it was in previous months, I'm noticing. Although, I mean, most of the deals are still garbage, but that's okay.
Well, it's always going to be like that. It's always, I can promise you this, even when the market does finally, tank and go down, and the deals will still be garbage for what they are for the market, most of them. And there's going to be just a few deals that you want to buy. Now, in hindsight, you'll go, I should have bought everything, right? But that's not the case at that time. There's a lot of uncertainty, when that point of the market happens. And so every deal isn't a home run. So that's always going to be the case. It's never going to be deals are falling from the sky and they're all amazing gold mines.
Yep.
So what are we going to hit on today?
Well, we're going to continue the multifamily series, and today we're going to be talking about emerging markets and how to figure out what a good market is for investing.
Yeah. And doesn't matter if you're going to invest in your own backyard or if you're investing in a totally different market. This information is really important. So many people get caught up in thinking, I know my own backyard really well. I've been here my whole life, or 10 years or whatever it is. And so they think they know it, but most people don't know it the way we should know it as multifamily investors. Now, you are an advantage that you do know your backyard, you know some things about it, but do you really, truly, fully understand it? Do you understand the trends? Do you understand what's happening? Do you know the companies that are coming in to the market? Do you know how many buildings are coming into the market? All that kind of stuff we need to really be actually data mining and figuring out. So that's what this is all about, whether you're investing in your own market or a different market. This is important. And this relates to even just a sub-market within the market as well.
Yep. Wherever you live might even be a terrible place to invest. So you need to be able to analyze that and know it if you're going to stay there or invest somewhere else that you don't live.
Yep. So if you're watching this on YouTube, we're going to be going through a slide deck. If you're listening to this on the Pillars of Wealth podcast, you're going to be obviously listening. You can't see this, but feel free to go on to the YouTube channel and you can look at the slide deck. But either way, I'm going to explain it to a way where you don't really have to visually see everything. We always get, I shouldn't say we always, some people get caught up into market cycles. And I just talked about, we're late in a cycle right now, but I feel like it's still a good time to buy. There are market cycles. We want to be aware of them. We want to try to understand as best we can where we kind of are in the cycle or and what the trends are, but we don't need to get too caught up in timing cycles. If you're caught up in timing cycles, you're going to you're never going to do well, in my opinion. But if we understand the trends and understand where potentially we are in the cycle, it allows us to strategize a little bit better to be successful, right? And so my strategy is slightly different right now in this cycle than it is in the early parts of a cycle. I'm much more conservative with my numbers, holding things more tightly to my chest. I am really looking for markets that have good rent affordability right now. I'm looking for those slow, steady growth markets, not the ones that see the big ups and downs. So there's certain things that I'm looking for today that if the market does go through a big cycle change and there are, value opportunities, I might be considering different things. So understanding kind of where you're at and the phases is important. Matt, what do you look for? I know what I look for in a market and in a property. What are you looking for in a market or property?
Opportunity is where it comes down to. And the numbers, the metrics that I look for specifically are job growth, income growth, reduction in crime, availability of units. So are there more units than there really need to be? Then that might not be a good market, that sort of stuff.
Yep.
Yeah.
Yeah, absolutely. Yeah. I mean, specifically for me, looking at a property, it's got to have cash flow, right? It's got to have cash flow. But the other thing that it has to have too beyond cash flow is it's got to have some sort of forced appreciation that I can do. So I have to have some sort of value add. I have to have something, some sort of deficiency that I can fix. And then it has to have appreciation, and I'm talking market appreciation. So I'm looking for the markets. I'm looking for the areas in the market that are poised for growth, and that's what you just mentioned, right? Looking for job growth, looking for population growth, looking for uh, opportunities, basically. So I want to appreciate a market with job growth. I want it to be landlord friendly. I want that rent affordability that I talked about, and like you said too, that low new inventory. We don't want a bunch of new builds jumping out on us all over the place, and they're sitting there vacant, or there's tons of concessions, that type of stuff. I mean, right now in the Twin Cities, we're seeing a lot of concessions. We're seeing in Minneapolis specifically, we're seeing a very, very high rate of concessions, and that's concerning. So we want to be looking for markets that don't have that, and we feel won't be having that soon,
Mhm.
right?
Yeah.
So I want to see markets that have a population growth far exceeding my delivery growth, which delivery of units, right?
Yep. And I'd say cities change over years and decades, really.
Yeah.
So you look at the metrics for a long period of time, and then you can kind of project where things are going to be in the future.
Yep. Yep. You always got to be looking at this stuff, right? It's not just a one-time deal. You don't just like go, hey, I'm going to invest in Phoenix, Arizona, and look at the data one time and then never look at it again. You can't do that. You've got to continue to be looking at this data and understanding what's going on.
You got to have your fingers on the pulse.
Yep, absolutely. So for me, when I'm looking at a market, I want to see the average income level, average household income be above 35 or $35,000. I want to see population growth. I want to see population growth within 5 miles of where I'm at. I also want to see job growth within 5 miles. I don't want to be in an area where we just don't have a lot of job growth happening, because that's going to stagnate that market, that sub market. So when I'm talking specifically looking at a property, well, a lot of people maybe know or don't know, but like Chicago, for instance, Chicago is a perfect city where, if you get close to the lake and some of the suburbs, there's growth happening. The market's great, but you're going to buy these properties for low cap rates. But if you go into some of these neighborhoods that just are super stagnant, you can get a 10 cap, 12 cap, at least on paper, right? But it doesn't mean it's a good investment. What happens is these properties become vacant because nobody's looking for a place there. They're trying to move out. They're not trying to move in. The only reason why they're living there is because they're kind of stuck there, right? They're trying to figure out how they can get out of that area. There's higher crime. There's no jobs. There's no reason for them to be there. So, and that happens. That's not just Chicago. This happens in every city, every major metro. So, one of the big things I really look for, and I've mentioned this already, is the rent affordability. I want my rent affordability to be 25% of income. So if the average income is $35,000, I want my tenants to be paying 25% of that on average. Right. And so that's what I'm looking for. I don't want the rent to be $2,000 and $2,000 a month and a tenant's making, $5,000 a month. That's not affordable for them. They're not going to be able to keep up with the payments. And eventually when the market changes, I'm going to be sitting there with a bunch of vacant buildings. That makes no sense. Hey, real quick, I just want to let you know about the multifamily challenge that we got going on. It's a 5-day multifamily challenge on how to get an offer in quickly, right? So we're going to teach you in 5 days, 5 1-hour sessions. We're going to go through the steps and the process to get there. So go to mfichallenge.com, mfichallenge.com. You can sign up. It's free if you want the VIP. There's a bunch of things that we'll give away too. You do have to pay for that, but hey, it's going to be well worth it. Again, you can get in for free. We're going to teach you how to get that offer across the table, get the LOI in, all the steps. So Ellis Hammond and Ellis was episode 316. Check out his episode. And we're going to be doing this next week. So sign up now at mfichallenge.com, mfichallenge.com, and get in there. We're doing it next week, and it's going to be awesome. So hope to see you there. What else, Matt?
I would say job opportunities. You want to have places where there's a lot of companies moving in and a diverse types of jobs. You don't want it to be all one type of job. Like Detroit, when the auto industry went belly up, that really devastated that city. Now it's becoming more diverse, but you don't want to put yourself at risk of that one industry that gets destroyed and everything else goes down because of that.
Yeah, I mean, look, think of the Rust Belt, right? Anywhere in the Rust Belt got hammered. So job diversity is huge. I don't like when a market has over 20% in one industry. I think of like San Francisco, the Silicon Valley area. They're very highly tech orientated, and you might go, well, tech is here to stay. It's not going anywhere. I agree, but nobody expected auto manufacturing to go away either. Tech is changing. It's ever evolving. So when you have one area so focused on certain sectors, there's opportunity for that to get disrupted. And I don't want to sit here and predict that San Francisco is the next Detroit. Maybe it is, maybe it's not, but it's something to be cognizant of when you're looking at investing in an area is how diverse is that job force? Is it focused on one industry or is it not? I would prefer to not bet on one industry. The other thing too, we might have a bunch of jobs coming to the market. What type of jobs are they? Now, everybody says, oh, Amazon's got a new shipping, they're bringing in 2,000 jobs or whatever. That's great. It doesn't hurt anybody. But what type of jobs are they? Well, a lot of those jobs are very basic, kind of low level jobs, a couple maybe managerial jobs, but mostly lower level jobs. Well, again, that's good. We need those jobs, but that doesn't spur massive growth, right? What spurs large growth is if we can have some of those jobs, we can have some managerial jobs, and we can have some executive jobs. We have a good, diverse kind of percentage of each of those jobs coming in. And guess what? The people that make a lot of money spend a lot of money. And what does that do? It brings in more jobs. So the higher paying jobs actually bring in more jobs. And that's something you have to be looking at. If are we having just low paying jobs coming in, only high paying jobs coming in, or we got a nice diverse allotment of jobs coming in?
Great point.
Yeah. I think along with job creation follows population growth, right? So what are we looking for with population growth?
I would say steady. You don't want major sort of fluctuations like you were saying earlier, but I really like to see increase in my target population. So who are going to be my tenants? Are my tenants young urban professionals, that sort of thing? I want to see that sort of 25 to 40-year old increasing versus like older people.
Well, that's a good point. It depends on your demographic, right? If we got a lot of older people coming in, that is definitely a good thing, especially if you're catering towards that generation. So if you're going to do a lot of 55 plus communities, well, then that's what we do want to see. But if we're going to do your traditional apartment building, then the younger generation definitely needs to be coming in because those are your renters. And yeah, your 55 plus are sometimes your renters, but not nearly as large a percentage as your 20 to 30-year-old population. So that's definitely true. I want to really to focus on where it's actually happening. Every city has a path of progress. And so just think about the market that you're living. There's certain areas that are really growing or really highly desirable. If you look at the Twin Cities, for instance, so you got Minneapolis, and then you got really honestly going west of Minneapolis along the 394 corridor is very high demand, and we can spread from there and go to the south more, go to the north slightly, but not nearly as much to the north. It's mostly west, southwest, a little bit slightly north, but not very far north. If you look at, the rest of the Twin Cities, there's maybe a couple pockets, but that's the big area of generalized growth. Then there's other small areas of pocketed growth as well. So we want to look, where's that path of progress? What's going on? And we want to be within that path of progress. It's also nice to get in to the path of progress early. There's path of progresses that do pop up, and if you can time it to get in early, that's great. I wouldn't, again, timing the market's difficult and unpredictable, and so I wouldn't focus on just timing the market. I would be focusing on what you already know and where it's going. So.
And each city has a plan of where they want to be. So if you can look at where new roads are going to be planned to build or light rail stations, that sort of stuff, then that gives you an idea of good areas to expect that you can buy in.
Yeah. Well, back to the population, I really like larger MSAs. I personally want to see the MSA, and by MSA, I mean metropolitan service area. So think of the city and the suburbs. I really would prefer them to be about 500,000 or larger in population. That gives me not only tenants to pull from, so think higher occupancy, less disruption to your occupancy, but it also gives me people to work at my properties. So I need property management, I need on-site leasing, I need maintenance. Gives me an opportunity to get those types of people there. If I'm in a really small city, especially if it's a small city that's not near large cities, it's going to be really tough for me to get contractors and so on available. Now they are cheaper. So if you do find a really good contractor that's extremely reliable, that might be a good thing. But boy, that something goes wrong with them, they get sick, they move, whatever. Now you got to find somebody new, and that can be really challenging.
And those larger MSAs often mean that there's more availability of apartment buildings to buy as well. Not always, but often.
Yep. What else, Matt? Why don't you hit on permits pulled and what's going on there? Why is that important?
So when there's more permits being pulled, that means that there's more stock being built up, more newer buildings, more A+ quality places. So it means that there's, while more competition in there to be able to get tenants, depending on what your target market or your target population that you're going for is, it might not necessarily be competitors, but you have to be really thoughtful about, the more stock that's in an area. So if you're going for like B or C level places, then the A+ might not necessarily impact you so much.
Yeah, it may not, and it may. So yeah, you definitely want to be aware, because once we start having a lot of concessions in the market, once we start seeing rent decline, it typically is a trickle down. Now you might still maintain high occupancy, right? Because your C class tenants are not moving into the A class building that was built. But if you're seeing rent declines in the A class, that could trickle down depending on how far it goes. So we definitely want to be aware of it. The other thing that we want to be aware of is more than just multifamily as well. We want to be aware of single family too. I want to be aware of what's actually being built in the market, because let's just say I've got a population increase in 1 year of 50,000 people, and we've got 45,000 units being built total. Well, we know that a population of 50,000 people doesn't mean 50,000 new households, right? It we need to be putting the amount of units that we put into the market needs to match the amount of households being formed in the market. So we got to be looking at that, kind of paying attention to how many households are moving in and being formed, versus how many units are being built overall. So we one of the best ways is there's most cities track the absorption rate, meaning the amount of units being brought to the market versus the amount of new units being rented in the market. We want that absorption rate to be as close to even as possible, or better. We would rather have more people trying to move into the units than the units being built. Another good way is tracking the concessions, tracking the vacancy rate. And the higher the vacancy goes, the more the vacancy goes up. Obviously, we know we're probably overbuilding. Same thing with concessions. If we start having 1, 2 month, 3 month concessions, we know something's going on there. So, um,
Say one side thought about looking at population growth. You can always pull up the U-Hauls. If there's lots of U-Hauls being transferred to a particular area, that means lots of people are moving there and bringing their stuff into town, and that's a good sign for population.
yeah, U-Haul actually prints. They put that data out there for everybody, so you can just go and you could type in U-Haul population growth, and you could see that information there. So that is a good point. A lot of this stuff, by the way, we can get for free, right? There's a ton of resources out there. One of my favorite things is these real estate brokerage firms, this commercial real estate brokerage firms. They do massive data analysis. And so if you go to a CBRE or Marcus Millichap, Cushman Wakefield, Colliers, any of these big commercial brokerages, they're going to have all this information that you need set out for you. Now, trust but verify, right? But it's all free, it's all out there. You can look it up on the city's websites, you can look it up in Neighborhood Scout, City Data. Um, there's so many different websites out there that you can get this information for free. So the next thing, government planning. We want to make sure that the government's actually doing something that's going to help the city, not hurt the city, and landlords as well. Look at the city of Minneapolis just trying to put down rent control. Is a city you're looking at trying to do rent control? That could be very damaging to your business. And so you want to be in cities that actually want the landlords there, that aren't trying to criminalize them. And so we want to know what's going on with the landlord friendly laws or landlord unfriendly laws. And the other thing too is we want to know, does the city actually have a plan? Do they have a plan to grow the city? Do they have a plan to bring in businesses? Are there nonprofits that are bringing in businesses? Is Chamber of Commerce active in bringing in businesses? And then what type of businesses do they really want to bring in? As you mentioned already, like where are they building new roads and light rail and stuff like that? City parks, convention centers. What's their comprehensive plan? So you can go on to Google and just Google whatever city you're interested. If you're interested in Tampa, Florida, Tampa Bay, you can type in Tampa comprehensive plan, and you'll get to the city's website and their comprehensive plan. You can read through it, and typically they have sections on what they're development plans are and kind of see what they're doing. Do they have a plan? I think that's the biggest thing. Do they have a plan? And then what is that? What's it look like? Also, do they have tax incentives that are favorable or unfavorable for you as a property owner? All right, Matt, why don't you start with rent affordability? Hit on that. I've already touched on it. So this one's pretty quick.
It's a hugely important factor because if tenants can't afford to live in your units, then they're not going to stay there long, and you're going to have empty places pretty well. I know you like to have you like to buy properties in places where the median income is about 25% of what the average rent is going to be. It could be like up to 33%, but no, definitely no more than that. 25 gives you cushion. If somebody's paying, let's say, more than 50% of their income just for their housing, I mean, they've got other bills. They've got utilities and medical and credit cards and food and everything else. They're not going to be able to afford rent. Usually rent is somebody's biggest single bill. And if they can't afford that, or like if they have hard times, that's the first thing that they're going to skip on.
Yep. Yep. Well, and one of the reasons I like the 20-25% range is because now I have some room for growth, right? If the median rent is 25% of the income, I actually have some room to push my rents where I'm not stressing my tenants to that point, that breaking point. But if it's already at 33% or 30%, I don't have room for growth. And so it can only go up as fast as the income goes up. So I can really only raise it. Let's say income's going up by 1%. I can only raise it by 1% in order to keep them comfortable. If I raise it 2, 3, 4%, all of a sudden I get stressed out tenants because they can't afford their bills anymore. And they're wondering why. Where again, if it's at 20%, I can raise it 4%, even though the income only goes up by 1%. I can raise it 5%. And they can still afford it because they're not even pushing to their max limit. So that's a big reason why I like good rent affordability.
Yeah, it makes sense.
All right. So we already talked about the absorption rate and the vacancy rate, why those are important. So I can skip that. You mentioned opportunity to purchase. Why is that? Why do you care about that? Like, there's always opportunity, right?
Well, yes, there's always opportunity, but it just depends how much. Is there a lot of stock trading hands in a particular market? That might mean that there's more competition, but there's also more deals that you can look at and try to find opportunities. But places like, you and I live in the Twin Cities, and not very many places trade hands. I know just the culture here, people buy and hold for long periods of time in the Twin Cities. Yep. So there's just not much that comes up for sale. And so you can find good deals and whatnot, but it's just few and far between.
Yeah, 100%. So, look for markets that people are actually trading their properties. If they're trading, there's just, it's weird. There's markets out there. I feel like a lot of the Midwest upper, kind of the North, like Minnesota, Midwest, they're just like kind of more traditionalists. We're going to hang on to our properties forever. We're going to buy them. We're going to hold them. And that's what we do. Where you get to other areas, Southwest, Southeast, South, they're flipping properties. They're buying a property, they're renovating it, they're keeping it for 5 years, and then they're moving on. It's rare that they hold on to their properties for 20 years. Or Minnesota, it's rare that you sell your properties in under 20 years. So you just hold on to them. You buy them, you hold them, you keep them forever. That's just kind of how it's traditionally been here. And it hasn't stopped. It's maybe changed a little bit, but it hasn't stopped. So look for markets where there's actually deals. Can you still buy deals in markets like the Twin Cities? Absolutely. You definitely can. It takes a lot of work. So you got to look at what's the best use of your time? What's the best opportunity for you? So as I said, there's a ton of information that you can find without paying for it online. Now, if you want a real detailed study, you're going to probably have to pay for it. But there's a lot of good information that you can get. You don't have to pay for. I've mentioned a couple of them. Neighborhood Scout, that's free. If you want to subscribe, of course, there's a trial period that you can get. You can subscribe. They've got other data that they give you when you subscribe. City data, National Apartment Association. There's Milken's Bass. There's your Chamber of Commerce, your city websites. Of course, the Census Bureau, the Bureau of Labor Statistics. So there's just so many great resources out there. And again, you could just go onto your search engine and just do some searches, and you can find some great information as well.
Yep, you can look at crime maps and sex offender registry maps to see what some heavy hitting areas are.
Yeah, so Trulia.com has some crime mapping. Neighborhood Scout has some crime mapping. Your city websites should have some crime mapping. So yeah, there's a lot of good data out there that you can get to. Local business journals are really good as well. They've got a lot of very good local information that's going to provide you a big insight to what's going on. Awesome. All right. Well, that's all I got. Choose your markets wisely. Choose your neighborhoods wisely. We want to buy real estate that not only cash flows, but appreciates. I want stuff that appreciates faster than just your average market. I want to look in areas and find areas that have real solid growth and they're poised for a good future.
Hey, me too.
All right, Matt, you have a fantastic rest of the day. Make every day a Saturday.
Sounds good.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.